Healthcare stocks have been getting hammered lately, but that might mean it's the perfect time to buy. I've screened through 2,000 plus names in the sector to find 5 that should be on every investor's radar for 2020. I'll not only show you those best healthcare stocks to buy, but reveal why this entire group of stocks could be ready to explode. We're talking healthcare stocks to buy today on Let's Talk Money.
Beat debt.
Make money.
Make your money work for you.
Creating the financial future you deserve.
Let's talk money.
Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. A special shout out to everyone in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Today is part 4 in our series of the best stocks to buy from each sector in 2020, and I'm excited about this one. Today we get into one of the big universal forces that I've been following for more than a decade, first as an economist and then as an equity analyst. Not only will healthcare stocks benefit from an aging population, that big picture trend, but this is going to be one of the best safety sectors you can buy. So what I want to do is going to be a little different from our previous sector investing videos. Instead of talking about how I picked these 5 healthcare stocks to buy, I'm first going to cover the big catalysts for the sector and a strategy for getting the most out of the group. I'll then reveal my 5 top stocks in healthcare and why I think they should be in your long-term portfolio. I am loving this series, covering the best stocks in each sector, and it's something that is so important, but that most investors just don't realize. And creating a portfolio that not only beats the market, but is also diversified away from some of those biggest market risks means finding the best of breed companies within each sector. You can't just leave this up to chance, trying to find those best stocks to buy and hoping that you're diversified across stock sectors. It has to be a strategic effort. So over these 11 episodes, one for each stock sector, I'm going to show you how to pick the best of breed in each. If you're coming in later to the series, I'll link in the first comment below the video to the most recent video in the series. I'll also be linking in the video description all the videos in the series so you can see all the stocks for each sector. Very important here though, since we're not covering how I picked these stocks like we usually do, make sure you check out that first video in the series. In it, not only do I highlight some of the great tech stocks to buy this year, I detail the criteria I'm using to find these stocks across the entire series. Here's that graphic again, and today we're talking about the healthcare sector, so including drug stocks, biotech, medical services, and equipment. Comparing the sector performances here, we see that healthcare has lagged 4 of the 11 sectors and the market in that 5-year period with a 40% return and has actually produced just a 4% return over the last year, lagging every sector except energy stocks. So it seems the sector had a real breakout period from 2012 through 2015 where it outperformed the market, but it's lagged it ever since. Now that's not necessarily a bad thing, as it actually means healthcare stocks aren't as expensive as the rest of the stock market. If you look at the sectors here on a price to earnings basis, so how much investors are paying for those earnings per share, we see that healthcare stocks are actually the second least expensive after financials. Healthcare stocks are trading for 14.8 times analyst expectations for earnings. That's that dark blue bar here. If you look at the green bar, the 10-year average multiple for the sector is 14.3 times. Now that means stocks in this group are trading for only 3.5% more expensive compared to that longer term average, which is really nice considering some of these other sectors like tech trading for 31% over its average and the market itself at 14% more than its long-term average. Besides those fundamental reasons to look at the sector, you've also got a group of stocks with an extremely stable revenue stream and pricing power. Inflation and healthcare costs have grown at 3.4% annually over the last 2 decades against just 2.1% growth in overall inflation. And it's that universal force of an aging population. Over 10,000 baby boomers are reaching 65 years old every single day. That trend is going to continue until 2029. They're moving into an age group that spends twice the amount on prescription drugs, hospital services, and other healthcare costs. Now, of course, the big overhang on healthcare stocks has always been regulation, or the threat of it by Washington. Now, I'm not going to get into a debate about the cost or price controls. I'm here to help you make money, not to put together a perfect society. Regulation is always going to be a threat to profit for these companies in the space, and it's something that you need to watch for, but it's also something that these companies have had to manage every single day. Instead of worrying about what might be passed, focus on the best of breed companies in this sector, in this healthcare stocks, the best management teams running these companies, and let them worry about that regulation. Now I want to reveal those 5 best healthcare stocks to buy, but first let's look at 3 exchange traded funds, 3 ETFs that you can buy to get that broad exposure to the sector. Use these if you can't find individual companies that you want to buy so you get that broader exposure for your portfolio. First, we've got the Healthcare Select Sector Spider Fund, ticker XLV, with its 1.6% dividend yield and a super low 0.13% expense ratio. The fund is pretty well diversified across industries in the sector, so it's going to give you that overall investment. Now, healthcare is an extremely diverse sector with growth industries like biotech and then more stable companies in the services segment. Getting exactly the theme that you want might mean looking for a fund that covers or excludes a specific industry. So maybe if you want that growth part of healthcare, you go to the iShares NASDAQ Biotechnology Fund, or ticker IBB. This one is more expensive with an expense ratio of 0.47% and doesn't pay much of a dividend at all. But the idea is that you get that faster growth, and the fund has produced a 14% annualized return over the last decade, so it might be something to watch. Or conversely, if you want a more stable return and want healthcare without that volatile biotech group, you can go with something like this iShares US Healthcare Providers, ticker IHF. Now this one is also slightly more expensive with a 0.43% expense ratio, but you do get an excellent 4% dividend yield, and it's produced a 15% annual return over the last decade. The fund is split among the more stable industries in the sector, like managed healthcare, services, and facilities, so you shouldn't get those big ups and downs you see in biotech. Now let's look at the 5 stocks I found that should be on everyone's radar, and what I've tried to do here is look for the best-of-breed companies across industries in healthcare. So I want to give you ideas across that whole sector. So we've got some drug makers and distributors. We've got a biotech name, a services company, and one in the retail consumer segment. CVS Health, ticker CVS, has gone nowhere this year, but if you want one company that represents almost the entire healthcare sector, this is it. Between the 9,800 retail pharmacies, insurance under the Aetna acquisition, a PBM, and managed care organization, this company controls just about every step in that healthcare chain except drug making. Now, being able to control almost that entire supply chain from discounts on buying pharmaceuticals to the patient experience, that advantage helps CVS control costs and customers like no other company you'll find. Shares trade for just 9.5 times earnings, which is a welcome change after some of these other sectors we've covered, with shares topping 20 times earnings and higher. Analysts expect earnings to be slightly lower over the next year, but given management's ability to consistently beat expectations, I think EPS could come out flat to around $7.50 a share over the next 4 quarters. Now, as you're thinking about any of these healthcare stocks, but especially CVS, understand that the rhetoric is going to be getting hot and heavy the closer we get to that 2020 election. Healthcare is a hot button issue, and railing against the company profits always plays well with voters. It's going to happen from both sides, but I would look at any news-related dips as just buying opportunities. Just look at what regulation has changed in the past. Pretty much nothing, and I don't think we have too much to worry about in the near future. CVS is well covered with 13 analysts providing price targets. We've got a low target here of $63 a share, which is slightly below the current price, and a high of $91 a share for a 35% gain. Merck, ticker MRK, is one of the most diversified drug makers in the sector, with a strong pipeline of drugs in heart disease, cancer, a vaccine business, and even sales in the animal health space. This is a $212 billion company with operating cash flow of almost $11 billion a year. The scale and cash power here is unmatched by just about any other drug maker, which is hugely important when you consider that the average of $800 million to bring a big drug to market. Merck has a cash flow opportunity with its Keytruda and Lynparza blockbusters, and is using almost $15 billion a year to buy back shares and then pay out that dividend. Shares trade for 16 times earnings, but look at the blowout third quarter they just announced. Merck beat earnings expectations by 21% over that quarter. Earnings are expected 2.5% higher over the next 4 quarters, but given management's history, we could see the actual number much higher than that $5.23 per share expected. Merck has largely missed that opioid litigation against many of the other drug makers, so it could have the opportunity to really speed ahead in some of these key drug segments while those competitors are facing uncertainty in the courts. Analysts have a low target of $89 a share, which is just above the current price, and a high target of $105 each, which would be a 26% return on the shares. At a $26 billion market cap, McKesson is the world's largest pharmaceutical and medical supply distributor in the world. For example, with Merck, you've got a drug maker, and with CVS, you've got a retail pharmacy. McKesson is the company that sits in between the two, negotiating the lower prices with Merck and selling to CVS. Between the 3 distributors, McKesson, AmerisourceBergen, and Cardinal Health, these 3 companies control over 90% of the distribution business globally. What I like about McKesson is that it also has its own retail pharmacies and an IT infrastructure that really helps it manage that supply chain better than any of the other competitors. Now, of course, this controlling status over pricing between pharmacies and drug makers puts McKesson and its 2 peers right in the middle of the fight over drug prices. It's unavoidable, and there will be bound to be ups and downs whenever the issue comes up. Now, the group has been working through a major settlement over the opioid crisis and has enough financial flexibility, though, to negotiate any drug pricing legislation. Shares trade for 9.7 times earnings, which are expected higher by 5.8% over the next year. That's not a huge move, but stable, and I think just clearing out some of the uncertainty around that opioid litigation is going to be enough to send these shares higher. Analysts see the shares at a low of around 135 over the next year, or as high as 169 per share, which would be a return of 25% over the period. United Health Group, ticker UNH, is the largest private health insurer in the US, as well as having a strong business line internationally. The company insures 50 million members, covering 15% of the insured population. That puts it well above its next largest rival with just 10% of the market. Now combine this scale with a strong health information technology business and a pharmacy benefits manager to negotiate costs, you've got a business model that just can't be beat. In fact, the CVS-Aetna merger and the Cigna Express Scripts mergers over the last several years were both an attempt to copy this United Health business model. Shares trade for 17.3 times earnings, so a little more expensive than the other stocks on the list, but maybe worth it on that remarkably stable earnings growth. Earnings are expected almost 11% higher over the next year and will likely be much higher considering management's history of beating expectations. This is another one that could be uncharacteristically volatile around headlines going into the 2020 elections, but where the dips could be buying opportunities. For all the talk around government-paid health coverage or universal coverage, nobody has a workable plan or a way to pay for it that could get through Congress. Analysts have a low target around 257 per share over the next year, with a high at 310 per share, which would be a 24% return from current prices. Gilead Sciences, ticker GILD, is another solid stock in the drug maker space with a 4% dividend that beats most others. Gilead is the leader in drugs treating HIV and hepatitis, two of the highest profit margin markets in drug making. In fact, Gilead is so successful in HIV treatments that it serves 80% of the patients in the United States. Shares trade for 9.7 times earnings on a PE basis, with earnings expected 4.6% higher over the next year. Now, that first and fourth quarter, the next two to be reported, have historically been weak for Gilead, so you might want to buy half of your investment now and wait to see if the shares fall on those bad earnings releases when those next two reports come out. Analysts have a low target at $66 a share, right where the stock is now, and a high target of $95 a share, or 45% higher than the current trade. Watch the first video in the series, the best tech stocks to buy right now, and the factors I use to find stocks in these videos by clicking on that video to the right. Don't just follow me into these stocks. Find out how I picked them and how to find other great investments. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.